Today I would like to analyze Universal Music, one of the largest music companies in the world. They have a lot of famous artists and they own a lot of the music as well. We can see we had a strong performance in the last 6 months. We are up close to 26%, so we're going to take a look at the financials to find out if it's a good buy right now. The first thing we can recognize is a market cap of 50.53 billion euro. This makes Universal Music the 9th largest entertainment company in the world by the market cap. We also have a dividend yield of around 2.03%, which we can see here did grow in a very good rate in the last years. Now we're going to take a look at the financials. The first thing we're looking for is revenue growth in the last 5 years. We want to invest in a growing business and not a declining business. So in 2020, the revenue was around 7.43 billion euro. This was a decent growth around 3.8% from 2019. Then in 2021, we saw the good growth around 14%. This is something we like to see. In 2022, we saw the even better growth around 21%. This is very good. In 2023, we saw the decent growth around 7.4%. And then in 2024, we saw the decent growth again around 6.5%. So overall, what can we say? I think we had a good revenue growth in the last 5 years. So as a check here. The next thing we're looking for is the free cash flow growth in the last 5 years. The free cash flow is very important because it can be used to pay the dividend, to pay the stock buybacks, to invest in the business, and also to pay back the debt. So in 2020, the free cash flow was around 0.9 billion euro. This was a strong growth around 47% from 2019. Something we like to see. In 2021, we saw the strong growth again around 25%. Then in 2022, we saw the very strong growth around 50%. And then in 2023, we saw the decent growth around 8%. And then in 2024, we saw the decline around 9.4%. This is something we don't like to see. But overall, it's still a check here. I think we had the very good free cash flow growth in the last 5 years. If we take a look at the gross profit, we can see a very good growth rate in the last 5 years. Also in 2024, where we saw the free cash flow decline. So the reason for that can be the higher advances to the artist. Maybe they need to pay upfront more money to sign some artists. We can also have some other reason. Maybe the royalty money can come in more late. So overall, we can see this business is still growing in a very good rate. So the next thing we're looking for would be a free cash flow yield over 4%. This can also tell us about the valuation of this company. The higher the free cash flow yield, the higher the indication for undervaluation. So we're going to take the free cash flow from 2024, 1.66 billion euro. We're going to divide it with the market cap, 50.53 billion. Then we're going to get the free cash flow yield for 2024. So the number we're going to get would be around 3.28%. So this is under 4% obviously, so it could be an indication for overvaluation, but we also can expect the free cash flow to grow in the future as well. If we ask ChatGPT for future free cash flow assumptions, we can see here in 2025 the free cash flow could be around 1.76 billion US dollar, in 2026 around 2.07 billion US dollar, in 2027 around 2.23 billion US dollar. So let's assume for 2027 around 2.23 billion. Then we're going to divide it with the current market cap, 50.53. Then we're going to get the free cash flow yield for 2027 with our free cash flow assumptions. So the number we're going to get would be around 4.41%. And I think this is a decent number already. It would be over 4% and it would be a check here for 2027. The next thing we're looking for is a debt to free cash flow ratio under 5. This means the company can repay the debt with the free cash flow in under 5 years. A very important number, because if a company has too much debt and cannot repay the debt, it can risk to go bankrupt. So first we're going to take a look at the long-term debt, 1.78 billion US dollar. Then we're going to take a look at the short-term debt as well. So the short-term debt is here around 0.87 billion. We're going to divide it with the current free cash flow. This is around 1.66 billion. Then we're going to get the debt to free cash flow ratio for 2024 around 1.59. And I would say this is a very good number actually. It means in 1.5 years we can repay the debt with the free cash flow. So the check here, we like to see that. We can also take a look at the cash on hand, how much money this company has in the bank. We can see here around 0.58 billion. I think is also a decent amount. So overall, I think this company has a good balance sheet. The next thing we're looking for is the enterprise valuation to free cash flow ratio under 25. So this can also tell us about the valuation of this company. The lower the number gets, the higher the indication for undervaluation. So we want to see a low number here. First, you're going to calculate the enterprise valuation. This is the current market cap, 50.53 billion. We're going to add the debt, 2.65 billion. Going to take minus the cash, 0.58 billion. So then we're going to get the enterprise valuation. This is around 52.6 billion. So this is how much the whole company is worth. So then we're going to divide it with the current free cash flow, 1.66 billion. So then we're going to get the ratio that we're looking for. This is quite high, around 31.68. So we want to see that number under 25. But of course, this company has also the expected free cash flow growth in the future. So right now it's not a check here. Well, we also can calculate this number with the free cash flow assumptions for 2027. So the 2.23 billion. So then we're going to get a different number. So the number we're going to get for that year is around 23.58. So this would be under 25. So this would be a decent valuation, I would say, but only if these assumptions are realistic for 2027. So I think this company can be overvalued right now if these free cash flow assumptions are lower in reality. The next thing we're looking for is shares outstanding decrease. This means the company buys back their own shares. We like to see that especially we think the company is undervalued. So we can see here the shares outstanding did not decrease over the years. It slightly increased in 2023. So overall it's not a check here, but I don't think this is a problem because it's still a young company on the stock market. Can Universal stock be a good buy right now? One of the best performing stocks in the last 6 months. We are up around 25%. So let's start with a positive about this company. We had a strong revenue growth in the last 5 years. We also had a strong free cash flow growth as well. This is something we really like to see. The balance sheet is also looking quite good. This means a low amount of debt and a good amount of cash on hand. The free cash flow yield around 3.28% is quite low. We want to see that number over 4%. So right now the free cash flow yield is low, but with our free cash flow assumptions for 2027, it could be around 4.41%, which would look already better. So right now the enterprise valuation to free cash flow ratio is quite high, around 31.68. We want to see that number under 25. With our free cash flow assumptions for 2027, this number would be around 23.58, which I would think is a decent valuation actually. We also have a dividend yield around 2.03%. So I think this company can be fair valued right now, but only if the free cash flow assumptions for the next years are realistic. But personally, I would wait if this company goes again around 24 or 23. This would be a better price to buy. If you found this video helpful, don't forget to like and comment and subscribe for more content.